local governments promises of pension benefits and lifetime health benefits for their employees, you're adding another 20 or 30 trillion dollars on top of that. So obviously it can't go on. Jose.
I want to follow up to what you said. That California bonding actually why do they get the money?
Well, right now, there's some articles I read today about that. They said California cannot issue bonds today at a reasonable price. They would probably have to pay 9 or 10% right now on bonds that they want to issue. So they're looking for a government bailout. They want the federal government to guarantee bond issues by California so they can sell them, and people will buy them and they'll have money to cover the budget deficit rather than actually cut spending.
That's dirty work. A couple of months ago, I was doing commercials about buy bonds.
I don't think the danger in buying bonds in California is that they won't be able to pay them back. The danger is that they'll decide they don't want to pay them back. They'll decide, hey, let's default. And then all of a sudden, all the interest they pay on the bonds is off the budget now. I mean, can you trust government?
No, what you're saying is federal government.
Exactly. This time, when the federal government bailed out New York City, it was only New York City that needed bailed out. Right now, it's not just, we might be the worst example. Actually, we're not. I think New York State is the worst example. But there are lots of states that have been bailed out now. And obviously the government's going to print money. And that's you're either going to lose it because you're going to decide you don't want to pay it, or more likely the Federal Reserve is going to create so much inflation that you're being paid back with dollars that aren't worth what you lend. I mean, even in a period where with 2% inflation, in 30 years everything doubles. Any inflation at all takes away a significant amount of the value of your dollars. If you can't earn. Right now, the CPI might show 0% or minus 1% year over year inflation, but that's not going to last. And the interest rates are going to be artificially kept. Well, they've been kept low. They've been kept below inflation rates, even when inflation is 2%. So that you could effectively borrow money and get paid for holding it. Or the government could anyway. So,
if you won't bond municipality as opposed to owning them on the state level. So if they were to default on the municipality what kind of insurance do you have for these local issues as opposed to state issues? Are they different, or is it all guaranteed by the state?
To the best of my knowledge, no local bonds are guaranteed by the state. They most of them are insured by one of these insurers, one of the half a dozen municipal bond insurance companies. If it's, as long as this small city or this town or this county goes under, they can probably pay the claims. But if there's a massive default, they can't. It's kind of like, like an earthquake. Yeah, you can write earthquake insurance as long as there's little earthquakes. But when the big one hits, it's all over. They don't have the money to pay you.
So the revenues of the municipality that they take in, where they pay the municipal bonds, right?
And it varies. Every bond is different. Every bond is different. Some bonds are, like the water company issues bonds, and the guarantee behind the bond is future revenues for the water company. And they may have bought bond insurance to get it higher rated if it was cheaper than paying the higher interest rates. I mean, I believe the reality is we all be better off if we bought uninsured municipal bonds and got more interest for it instead of paying off these bond insurers that, in case of a massive default, can't pay you anyway.
The federal government does bail out California in the sense of guaranteeing bonds and default. The free rider problem just start up where it's not any state now from over borrowing and driving in the short term and creating this everywhere.
Well, that's not really an insurance question, but you're right, absolutely. Every time another company gets bailed out, you create greater and greater moral hazard because more and more people are being protected from their own bad decisions. If California gets bailed out, it means 120 brain-dead morons and a total idiot governor get bailed out for a lot of bad decisions. The guy's brain atrophy from steroids. I have no more information you can read in the news. The only thing I'll say is what P.J. O'Rourke said. If you think healthcare is expensive now, wait till it's free. I mean, do you want health care from the post office? That's what they're talking about. You're going to have shortages of doctors. I mean, we've had Dr. Lagrelius talk to us a couple times. I mean, he's basically opted out of the whole insurance system. And I think you'll see more of that. But who knows? They may make that illegal. I mean, Hillary Care had provisions in it to make it illegal for you to pay a doctor to treat you outside of the system. So I wouldn't count on it. I mean,
any idea here at what kind of point of level of government debt, number-wise, we reach before things really start to actually collapse from it? The debt is, sort of a, I don't know what, a Mad Max kind of Ayn Rand, that was short kind of version of the world ending, I guess.
It's kind of like the dot-com bubble. There came a time in late 1999 when I looked at all these tech stocks and telecom stocks and said, I don't know how high they can go but there's nothing rational about where they are or how fast they've gotten there. So I don't know when, but they are going to drop. And I don't know what number is what magic number pushes the United States government into, total anarchy, which might be a good thing. But, I say, but what must happen will happen. There has to be a tipping point somewhere when nobody is willing to lend them a penny. And there'll become a point when no one will want the American dollar, and that's going to happen slowly. But just like everything was going wonderful, and then all of a sudden, October 2007, Why did